Hello, Travis with Tetelestai Bookkeeping for Real Estate Investors. Going to talk today about how to book a mortgage payment received and payment made when it's a wrap. To set this up a little bit, this is the scenario where the real estate investor purchases a property subject to an existing mortgage, leaves that mortgage in place, and then they sell the same property to another buyer and they hold the note for that property. So if you're a real estate investor, you know this strategy, you may have used this strategy, very popular in a certain niche and can be very profitable. The trick is booking these types of transactions accurately. So I think this is a good illustration of how you can use QuickBooks to keep everything accurate, going the right way. So let's take a look at this. But by the way, I didn't come up with this strategy and technique, process, workflow, procedure on my own. I got this from Nick Baldo with Income Digs. I highly recommend him as well. So let's start with what happens when you receive a mortgage payment from the borrower. So let's say we get a payment from the borrower. In other words, they're making the mortgage payment to us. We are holding the note. And this payment, we'd be splitting out the principal, the interest, and the taxes and insurance, the escrow amount, whatever that is. We're not going to deal with the principal and interest portion right now. That's a little more simple and basic, but we're going to deal with the taxes and insurance portion of the payment received from the borrower. So that amount, that escrow portion, is really not ours. We're just a pass through, and it's probably going to be the same amount. So in other words, they make a payment of $2,000 and $100 of it is principal. It's a new loan. And $1,500 of it is escrow. And the other $400 is taxes and insurance. We're just going to deal with that. So that is actually a liability. So that would be taxes and insurance payable. Because it's not ours, we're going to be paying that to the escrow company. Let's just say this is $1,000 to make it simple math. Actually, let's make it 500. It'll be a little more clear. Okay. So we've got a deposit. The taxes and insurance part of it is $500. Now we make a payment. The next step is we make a payment to the escrow company that is handling the loan. And so let's just say this is escrow company. We're going to make the payment from taxes, insurance, escrow, which is another current asset. Sorry, we're going to make that from checking. Okay, and the category is taxes, insurance, escrow. That's an asset. So what that means is we're making this payment to the escrow company of that same $500. But in this case, it's an asset because it's essentially a prepaid expense. The actual taxes and or insurance haven't been paid by the escrow company yet. So this is our money. This would be a liability on their books, right? It's an asset in our books. And let's actually change the date here. I have some other transactions in there that I don't want to. I want to be able to distinguish from. So let's make this the first. Let's go back and change the date of the deposit so we can see this. You can always go back in your history here. Here's my deposit. And let's make this the first. Okay. So far, I've received a payment from the borrower. A portion of that is taxes and escrow. We said $500. Then made the payment to the escrow company and the taxes and insurance portion of that $500. So liability is increased and the current asset is increased. So far, everything's great. The challenge comes in making when the escrow company actually makes the payment to the tax entity, could be property taxes, county, city, could be insurance. So when that happens, what we want to do is use our billable expense feature. So the let's just say it's a tax is made. We're making it from the taxes and insurance escrow asset account, right? That's where it's actually coming from. The expense category, we'll just say in this case, is taxes and licenses. Could be insurance. Depends on how you have your account set up. And let's just say it's $500. Now, this would accumulate. Of course, your liability would accumulate. Let's say it's $500 a month, and they make the payment once a year. So it's going to be approximately $6,000 when they actually make the payment. And you would only have to do this once a year when they actually make the payment. But for sake of illustration, let's use this. We're going to make this a billable expense, and it's billable to our borrower. So what we're saying is we're making this payment, but it's not actually us that's paying for the tax. It's our borrower. And where's that money coming from? Well, it's the money he paid us and is now in this asset account as a liability for him. So we can save and close this. We need to invoice the borrower. And as soon as you enter the borrower's name, you will have the option to add any billable expenses there. So invoice date 5/1, great, matches our expense, our billable expense, and we don't want to send it, so we can just save and close. And I just remembered that I think that expense, maybe I left a different date, so let's check that. Oh, no, I left that 5/1. QuickBooks is changing the default, learning a little bit. Okay, and so at this point, we've received the payment, we've made the payment, and then we've expensed it and it created an invoice. The last step is a journal entry. And we'll just keep everything the same date. So borrower owes $500 because of that billable expense income. That's a debit balance. This credit will clear it. How did he pay it? Well, he paid it by this liability. Okay, so debiting that liability will clear that out. In other words, he's not actually having any cash come out of his pocket again, of course, just like we didn't. So let's take a look now. What would you expect to see? Let's just run this on the as of May 1st. Okay. And let's start with the balance sheet. This will help. Let's see what's going on. Maybe. Okay, we're just going to do the balance sheet as of 5/1. Okay, let's take a look. So first of all, first part of our transaction was the payable, right? We received a payment into taxes and insurance payable. Then we know it's zero because it zeroed out. Let's take a look at what happened in there as of the first. We received that payment of $500, increased the liability, and we see our journal entry that cleared it out, which is exactly what we would expect, what we want. And what else hit the balance sheet? Our asset should have hit the balance sheet. Here's our asset. And again, we'd expect it to be zero. Both of those, the liability and the asset, would be accumulating during the year at the same rate. 500, 500, 500, 500. It's 1,000, it's 1,500. So we made that payment to the escrow company. Our asset increased by 500. Then when we made the tax, when they made the tax payment on our behalf, it came from the asset account, cleared it out. That's it as far as our balance sheet. Everything makes sense there. Let's look at the P&L. Again, as of the date of those transactions. We see billable expense income, $500, exactly what we'd expect because it was a billable expense to the borrower. And that is offset that by taxes and licenses right here when we made the payment, right? So we billed the borrower. We had income from that showing here, but it's not really income. That's what threw me off at first with this strategy. Nick pointed out that they zero out, which is helpful. I missed that. So you have income, but you're thinking, well, this isn't really income. I just collected tax and insurance from the borrower, and I paid the exact amount to the escrow company. I shouldn't have income. Well, true, but you paid, and we put it to taxes and licenses. You paid $500. So there's a zero net income between these two, which is exactly what we want. So that shows a fairly complex transaction or flow of money through a real estate investing company and how you can book that accurately. If you don't use that, the strategy here, you would have your asset accumulating and then your liability accumulating. But when the taxes and insurance were actually paid, if you just book those right from the checking account as an expense, your liability and your asset they're not cleared. That's not going to fix it. If you just reduced one or the other, the asset or the liability, of course, that's not going to take care of it. So this clears both. Great strategy. Nick is very helpful and knowledgeable on those types of things. I recommend his information, his products wholeheartedly. Any questions about this or anything with QuickBooks Online and real estate investing? Please post it in the comments.